What's happening, my money moguls in the making? Welcome back to another episode of the Do.Different.Better Show, where we bring you wealth, wisdom, and money moves, breaking down the financial tools that the wealthy have been using for decades and making them make sense for everyday people like you and me. I'm your host, Elaine Rasmussen, founder of Social Impact Now and the managing director of the Integrated Capital Fund. And today we're diving into one of the most under the radar investment vehicles. You've probably never heard of it, and it's called an SPV. That's right, a special purpose vehicle. And no, it's not a Tesla or a startup shuttle. It's a legal investment entity. And if you've never heard of one before, don't worry, you're not alone. But after this episode, you'll know what it is. You'll understand why it matters, and hopefully you'll figure out if it's something that you want to explore in your wealth building journey. But let's roll back and let's start with the basics. What the heck is an SPV? Last week, I talked with Cindy Willard from Charitable Impact, and I realized we never actually talked about an SPV. So I decided let's make it its own episode because it's jam-packed. So an SPV, or special purpose vehicle, is a legal entity created for one singular investment. That could be a startup company. It could be a real estate development project. It could be maybe it's a music catalog or even a brand new product line. Whatever the purpose is, it's special and it's a single purpose. This is the only thing that the investment dollars are going to be used for, right? Unlike a private equity company where your investment could be used or spread across multiple investments, right? And I believe there's a whole episode on private equity and how those actually work. An SPV is just for one single purpose or entity. So think of it like this. It's like a group chat, but with legal documents. It's when a bunch of people pool their money together to invest in one opportunity, and the SPV holds the investment on their behalf. You're not actually investing directly, but you're investing through the SPV. So let me give you an analogy, and hopefully this helps. An SPV is like an Uber pool, but for investing. You and a few other people are heading in the same direction. You all want to invest in the same company, but you're not trying to each drive your own car, or in this case, set up a trust, deal with lawyers, or negotiate with the founders all one-on-one. So what do? Instead, you ride together. You pay your share, and someone else, usually the SPV sponsor, drives. They handle all the legal stuff, they manage the communication, and they interface with the company or the asset or the founder, if that's the case. SPVs are used most commonly in venture capital. They're also used in real estate syndications. They're also used in film and media and intellectual property deals. If you just want to buy into the intellectual property, but not necessarily in the mechanism by which the intellectual property is going to be used. So that's a distinction. They are also used for co-investments into existing funds. So a pool of people might pool their fund to buy into a private investment, a private equity investment, right? So sometimes you will see them pop up on platforms like AngelList or Republic or WeFunder or Sidecar, or there might be some direct investor syndicates that you can take part of. Traditionally, SPVs were only used by venture capital firms and private equity funds or high net worth individuals. That would be people writing like six-figure checks, minimum $100,000, but typically upwards of $500,000, $600,000, $750,000. But more recently, more platforms have emerged that allow people like you and me to get involved with as little as $1,000 to $5,000. Now, that said, most SPVs still require that you be an accredited investor, but not all. But you definitely want to check that language. That means as an accredited investor, you earn over $200,000 a year individually or $300,000 with a spouse, or you have a net worth of over $1 million, not including your primary residence. And just a reminder, the accredited investing term or qualification is self-reported, but it is a qualification that is set by the IRS, right? So it's not some arbitrary thing. You can just call yourself an investor. And there's a whole nother reason that I talk about that on another episode. But what you want to understand is it is actually a term and a defined term that is set by the IRS, right? So you definitely want to be mindful when you see an investment opportunity that says accredited investor or non-accredited investor, and knowing where you fall in that scheme. But now there are actually some newer platforms that are using what's called Reg CF and Reg A plus exemptions to lower the bar to allow non-accredited investors to be able to make investments into opportunities that were previously only open to high net worth people or accredited investors. So I know some of you might be thinking, Elaine, I'm just trying to pay my rent and build a savings account. What's an SPV got to do with me? Well, here's why it matters. In one word, access. SPVs are the gateway to private market investing. This means you're no longer limited to just stocks and bonds and mutual funds. You can, one, get in early on a company before it goes public. Two, you can join a group of trusted people investing in something aligned with your values. Three, you can build real equity outside of Wall Street. And best of all, four, you don't have to do it alone. You're not buying a whole building. You're not writing a $50,000 or $75,000 check. You're sharing the risk and the reward. Just the other day, I was having a conversation with a friend of mine in Chicago, and her wife have been living in an apartment for a very long time. And they're thinking about, as they are now in their mid 40s, should they buy a home? They really want to stay in the city, but really can't afford to stay in the city. So I was talking to her about investing, and you can still live in your apartment because they really appreciated not having to have building maintenance to have to, or maintenance that they have to do. There's not a lawn that they have to mow. If they want something fixed, they can call somebody and it gets taken care of. They really like the ease, the comfort of not only being in the city, but none of the responsibility that comes with home ownership. So I was talking to her about, listen, there are other ways that you can stay in an apartment if that's what you want. Not only invest in real estate, and I have a whole episode on being an apartment dweller and investing in real estate, but SPVs could be a really great opportunity to invest and build equity or amass wealth, while, especially for your as you get into your twilight years, to be able to do that without necessarily having to be in the stock market, which she did not want to do, and without necessarily purchasing a home that she doesn't want to have any of the responsibilities for her and her wife. So SPVs are a great way to be able to make investments, especially if you're trying to create a portfolio that is off Wall Street. Not everybody, that's not a priority for everybody, and that's okay. But if that's something that's important to you, SPVs could be a really great vehicle that give you an alternative to the stock market or some other riskier options like venture capital. So now let's go and recap what we've learned so far. An SPV is a legal entity that is created to invest in one deal. It allows multiple people to pull their funds into a single investing opportunity. You typically need to be accredited, but that's changing and more opportunities are becoming available. It's also a very powerful way to access startup and private market investing with not the same necessarily level of risk. It is an investment, so like all investments, they all carry a level of risk. But This risk is lowered by the fact that you're not the only person who's making the investment and you're not on your own, and you don't have to amass all the extra fees that come with making a private investment, like lawyers and accountants. All of that is done for you in the SPV. So it just might be your next wealth move if you understand how to use it. Coming up in segment 2, I'm going to be talking about the pros and the cons of using an SPV. When does it actually make sense? When should you skip it? What are the fees and the risk and the realities? So I don't want you to go anywhere. You're listening to the Do Different Better Show. I'm your host, Elaine Rasmussen, and let's keep doing different better. I will see you after the break. Welcome back to the Do Different Better Show. I'm your host, Elaine Rasmussen, and we are diving into segment 2, which is a deeper dive into special purpose vehicles, or SPVs. That investment structure that has been low key, serving up major returns for folks who know how to use it. In segment 1, I broke down what SPVs are, who they're for, and why they matter. Now it's time to talk about the realities, the benefits, the risk, and how to know when an SPV is the right move or when you should walk away. So, first, the pros. You invest in what you believe in directly. SPVs are deal specific. This means you're not investing in a whole fund where someone else chooses where your money goes. You're choosing the opportunity you believe in, whether that's a Black woman-owned fintech startup, a community-owned real estate project, or a regenerative agriculture play. You get to decide. Number 2, there's a lower buy-in compared to a venture capital or private equity fund. Traditional VC funds often require a minimum $100,000 check or even $250,000. And depending on what it is, it could be even bigger, more than that. With SPVs, you can get in for as little as $1,000 to $10,000, depending on the platform and the sponsor. Last time on the show, we talked about a sponsor by the name of Impact Charitable. So definitely want to check that out. But that means that there's more access and more opportunity for people who are trying to build wealth without generational millions at their disposal, right? Maybe you're not a Vanderbilt and don't have oodles and oodles and oodles of money to go and write checks, but it is a place that you can start, and there are some opportunities. Number 3, risk is contained into one investment. Unlike being in a fund that has a pool of investments that you're investing in, your SPV exposure is limited to just that one deal. So if the investment flops, it doesn't drag your whole entire portfolio down with it. It's concentrated risk, but also it's controlled risk because it's a single entity or single use or single purpose. Number 4, it's a pass-through tax structure. SPVs are usually set up as LLCs, which means you don't get taxed twice. Instead, income or losses pass through to you as the investor. This can be a strategic tax move, though heads up, you will get a K-1 tax form. We'll talk about more on that in segment 3. And definitely I encourage you to talk to your tax professional to see what are the implications of that and is this an ideal opportunity for you. Number 5, legal liability shield. The SPV is its own legal entity. So if anything goes left with the investment, like a lawsuit, you're protected. Your personal assets are not at risk. And that can be a very big deal, particularly if you're just starting out doing this. The goal is not to lose everything, right? So you want to have as many risk mitigating opportunities or factors as you possibly can. Now, I'm not going to tell you the good without telling you the bad. Okay, so number one, the cons of SPVs. The first one is your money is locked up. SPVs are what we call illiquid. So remember, I've talked about illiquid and liquid. Illiquid means you can't just pull your money out like you can in the stock market. If the investment timeline is 5 to 7 years, you're in it for the long haul, which is also very similar to private equity. You're investing for a long period of time. There are no early exits and there's no secondary market most of the time. Number two, you usually need to be an accredited investor. The majority of SPVs are limited to accredited investors, meaning you've got to meet income or net worth requirements as outlined by the IRS. Some platforms are finding ways around that by using Reg CF and Reg A+, but they're not the norm. And when you talk to the sponsor, they typically will walk you through that and unpack that for you and identify whether you're an ideal candidate to invest in the SPVs that they offer. Number three, the K-1 tax form. Every year, you'll receive a Schedule K from the SPV. And if you invest in multiple SPVs, that's multiple K-1s to manage. They usually arrive late in the tax season, like March or April, which can delay filing. And if the SPV invested internationally, it could trigger additional IRS reporting. So you definitely want to be mindful of that. Again, talk to your accountant or the person who does your taxes. And if they are not familiar with SPVs, have them find somebody who is, because you don't want to find yourself in a situation because your accountant was ignorant of the rules. Okay. Number four, sponsor quality varies. An SPV sponsor is the person or entity managing the deal. They set up the entity, they communicate with the company or the founders, and report to the investors. If they're disorganized or not transparent, your experience can go south really, really fast. So you've got to vet your sponsor. Like any investment opportunity, don't just go in on a whim. Do your homework, do your diligence, talk to them, maybe talk to them several times before you actually decide. Unlike a private equity fund that may be time limited on when you can invest, and there's a window in which that you can invest, and if you come up against that window, it might be a week between the time that you find out about the opportunity and when they're going to close. An SPV, there's a little bit more flexibility as they're not necessarily time bound. But just remember, vet your sponsor. Number five, the lack of liquidity or a lack of a secondary market. Unlike public stocks, there's usually no way to sell your SPV shares, and they might be restricted in the paperwork or the contract that you sign. The investment contract that you sign may say that you cannot exit. So you definitely want to read the fine print, read the paperwork. If you have a lawyer, go through it with your lawyer, especially one that does corporate law. But you can't just sell your SPV shares unless the company exits or gets acquired. And that could take years to happen, depending on the type of investment that was made. Okay. So now that we've talked about that, the pros and the cons, when does it actually make sense to make use of an SPV? Here are 3 good use cases. Case number 1, you know the sponsor or the deal personally. So I told you I've known Cindy Willard for several years. We've been colleagues in the impact investing space. So if I were going to use an SPV, I would probably go to her because I know her, I trust her before I invest in a different SPV. Or if she did not have an investment that was ideal for me on her platform, I would ask her to refer me to another platform or another SPV sponsor. You want to trust the person leading the investment. Maybe it's the founder you believe in or an investor with a track record. That trust is your foundation. Case number two, you want targeted exposure. You don't want a whole fund. You want that one deal, and maybe it aligns with your values or your financial goals, or you've got some insider insight into what's happening in the market that makes it an ideal investment at this particular point in time. Case number three, you're building a portfolio across deals. Maybe you're thinking about you want to build your own micro portfolio by investing in 5 to 10 deals over a few years, leveraging investing in SPVs. That's a very smart way to diversify while maintaining control, because you don't necessarily have that control when you invest in a fund. Somebody else is not only managing the fund, but they're also picking the investments that are going to be in the fund, and you have no say in that. That's typically what happens in a private equity investment. While there may be an investment thesis of the types of investments that they're going to make, you actually don't get line of sight on what actually are the investments until after they've made the investment. They'll share with you, hey, these are the investments we made this year, this quarter, this month, whatever the situation may be. So now let's talk about when to say no. SPVs are powerful, but they are not for every situation. Say no if, one, you don't really fully understand the deal or the terms. Two, you can't afford to lose the money. Three, the sponsor can't seem to answer some basic questions. Four, you need liquidity, or you need access to your cash or the money that's represented in this investment within the next 12 to 24 months. Four, you're being pressured to invest quickly. Always remember, if the deal is solid, it'll still be there after you do your research. Unless, once again, it's time sensitive, but once again, that should not be a deciding factor. If you need to pass and wait for the next opportunity, you should do that. And definitely don't make any decisions under any sort of duress or any sort of, they say, like, once you've had a devastating situation, it's not a good time. Like if you've had a divorce or a death, that is not a good time to make a decision, an investment decision, or any major life decision, even moving, right? So this is no different. You definitely want to be mindful of, where am I sitting in my financial situation right now? How much can I afford to let go? And when I say let go, not necessarily lose in the market, but this money is going to be locked up for 5 to 7, maybe even longer amount of time, 5 to 7 years. And if you know that, hey, I'm going to have a kid that's graduating college in 7 years, I don't know if that timeline is going to work, because what if we have to hold over the money? So in the terms of the agreement, there might be a holdover that says, hey, while you're investing this for 7 years, we have an option of holding on to it for another 3 or 4 years under these particular circumstances. So if you say to yourself, hey, in 7 years, this is going to cash out, I'm going to have money for the college tuition. That may not necessarily be true, because the company may not be doing an exit. They may not be ready to sell, which means your money is going to be locked up for a little while longer. So definitely assess where you're at and what, where, and how the money that you're investing needs to be returned, right? Whether that's a return on investment or the return of the principal capital that you're investing. When are you getting it? And are you just leveraging this as a buy and hold strategy, which is optimal, right? As opposed to, I'm going to buy and cash out strategy, because it might take a little bit longer than you anticipate due to market circumstances, due to infrastructure circumstances, due to a lot of circumstances. So just because the investment might end in 7 years or 5 years does not necessarily mean it will. I sat on a investment committee, and we ended up not only staying with the organization over 20 years, we actually kept infusing capital, because structurally in the infrastructure of the organization, they needed more capital investment to continue to grow and scale. So once again, had we invested in that investment thinking we were going to get our money out in 7 to 10 years, we actually didn't get our money out for like 20 years, but that was okay because that was a very small portion of our investment portfolio. So we had already decided that it was a buy and hold strategy. So keeping the money in the fund, in the investment, was not going to be a problem. But not everybody has that luxury. So you just want to be thoughtful and mindful about what does that look like and what does that mean for you. So, okay, I know that was a lot. So let's recap. SPVs can open doors to wealth, but they do come with responsibility, which is no different than any other kind of investment, right? You're not just investing your money in an SPV, you're also investing your time, your trust, and your attention. But if used wisely, they are one of the most empowering financial instruments and for investing that is out there on the market. So I hope that you really feel like you've gotten a good grasp on like what the opportunity is, what are the pros and cons, when is a good time to leverage them. And coming up in segment 3, I'm going to show you exactly where to find SPVs and what you can expect when you join one and how to get started. I'm going to go over it step by step. And even if you're brand new to investing, we're going to break it down so that it's going to be easy to understand. So if you haven't already, I want you to go ahead and click the subscribe button. Feel free to follow me and find me on Instagram at Do Better with Elaine. And you know that you can find me on YouTube at Do Different Better. Stay tuned and catch me after the next break, where we're now going to break down all the ways to find SPVs and how to leverage them. I will see you after the break. All right, y'all. Welcome back to the Do Different Better Show. I am your host, Elaine Rasmussen, and we are now catching up on segment 3 of the Do Different Better Show. And if you're still here, then you're clearly ready to level up. And this next part is where theory meets action. So in the first couple of segments, we talked about what SPVs are, special purpose vehicles, why they matter, and the pros and the cons. Now let's talk about actually getting in on one safely, smartly, and you know me, strategically. So first, let's talk about where to find them. The first place you can find SPVs is on online investment platforms. These platforms are set up there. They manage the SPV, which makes it really easy to browse and invest. Excuse me. There are some really great options, and I've talked about Impact Charitable, but there's also AngelList. AngelList is known for tech startups and syndicates. So if you're really wanting to invest in like that next element of the tech revolution, then AngelList is probably a really good spot for you. Republic is another location. I actually had met the founder years ago when Republic just started. Really great. I think it's a couple of gentlemen that are from the Bay Area who started Republic. But Republic is a platform where it is equity crowdfunding with occasional SPVs. So on the Republic platform, it's collective investing, which is different than an SPV, right? So this is crowdfunding for equity in the companies that are on their platform. There's a lot of tech companies on the platform, but there are also a lot of other different kinds of companies on the platform. Some service-based businesses, predominantly. I haven't been on there recently, so I don't know if they have consumer packaged goods businesses or manufacturing businesses, but definitely it's been around. Republic has been around for a long time. I would say at least 8 years Republic has been around. So they've got some track record, solid opportunities. Definitely do your homework, but you can find out kind of collectively what's happened on the platform by going to their investor relations button at the bottom of the website. So Republic is another really good site that you could log into. Then there's Assure. Assure is really an infrastructure for setting up your own SPV, right? So if you think that you want to get into that, and I would only recommend that if you have some good investing experience already, right? I don't recommend this for somebody who's never made an investment ever in their life, right? But if you are a little bit more seasoned investor and you want some infrastructure to set up an SPV for an investment that you're trying to do in your community, or for a pool of people, trusted people that you already know, like I know there was a cabin that was available. And so I went to 3 of my girlfriends and I said, hey, let's go buy this cabin together. I don't want a whole cabin by myself. I wouldn't use it enough to make it worthwhile. But the 4 of us, at least 2 of us, had workshops that we wanted to do in a cabin-like setting. So it was going to be a business purchase for us, but the 4 of us could go in together and create our own SPV to be able to buy this property. So that's a really great situation where you could use the Assure platform to be able to create your own SPV, right? I've never used it. I've never been on the platform. So definitely do your homework. Then there is Sidecar. Sidecar is a new platform streaming SPV formation and investing. I also haven't had a chance to check that out, but I will, and I will leave comments on my YouTube channel. Then there is TribeVest. TribeVest is great for group investing with friends or networks. So it sounds like it's really similar to an Assure, but once again, I haven't been on it, so definitely check it out. But I'm going to check out all of these. I just didn't have an opportunity to do that before the show, and but I will leave comments and my experience on my channel, Do Different Better on YouTube. Now, some platforms may require an invite or some kind of vetting process. So just want to make sure that you look out for that. And once again, not be on a time crunch, right? Some of these things still take a little bit of time. You might have to submit paperwork. That paperwork you might have to go and get. So just want to be mindful of those kinds of things. Number 2, there are private syndicates or investor networks. So you can join a syndicate, which is basically a group of investors that are led by a lead who curates the deals. So folks who do this could be local angel networks. There are women-led syndicates. There are ethnic-based syndicates like Black Angel Tech Fund. There's Gangels, and there's also Pipeline Angels. I'm a big fan of Pipeline Angels. I know them. I knew the founder, and Pipeline Angels has now been acquired. And so it's a really great program for women to go through and learn how to become angels. So they also have a fund that the angels who graduate their program can pool their money to make investments. But there's also alumni investment clubs. So I know like Harvard has an investment club, the University of Minnesota has an investment club. So you might want to go to your alma mater and see, hey, are there investment club or clubs that are available that you could plug into? And then there's also founder-led investment clubs. These could be people who have been a founder and have exited, or it could be a group of founders that are getting together to invest in other people or invest in one of their businesses. But there's lots of opportunities that are out there that you can take advantage of and check out. And then 3, through founders or advisors. Some founders set up SPVs to raise from aligned investors. If you know a founder that you trust or a startup that you already support, you might be invited to join an SPV directly, right? And usually there's, these kinds of opportunities are really through your network. So if you're really wanting to invest hyper locally, then definitely I would encourage you to reach out to the entrepreneur ecosystem particularly the entrepreneur ecosystem that is closely aligned with the types of investment or businesses you want to invest in. If you're interested in med tech, go and find the ecosystem that supports med tech. If you're interested in fintech, go find the ecosystem that's related to that. And sometimes it's as simple as going onto Eventbrite and looking for meetups. And that's how you can kind of plug into the community. If you have an impact hub in your community, that is another good place to find the ecosystem for a variety of different kinds of entrepreneurs or by sector, right? If you're looking for consumer packaged goods, the SBDCs, so the small business development communities they're usually housed at universities. They can plug you into the ecosystem, which then helps it easier to find where are the investment opportunities that are local or in the community that you want to invest in. Say you might be living in the Twin Cities, but grew up in Little Rock, Arkansas. Plugging into that community in Little Rock, Arkansas will get you closely tied into the opportunities that are in that community. So now let's talk about what to expect, right? Especially as it relates to a minimum investment. It really could vary. It could be as low as $1,000 or as high as $50,000. But the typical range for a beginner-friendly SPV is about $2,500 to $10,000. Now let's talk about the timeline. Once again, I talked about this in segment 2. Plan to wait 5 to 10 years to get your money out. Sometimes it's shorter if it's a real estate flip or a secondary sale, but do not expect fast cash. That is not what this is. You've got to know that going in. It's super, super important. Very similar to a private equity investment. It is a buy and hold strategy. It is not necessarily where you can either, like the stock, even if the company is not buying the stock, there is a secondary market that you can sell and get your money back. This is not that. So you must want to be careful. So how do they communicate and keep you updated? Most SPVs provide quarterly updates. Some even include dashboards that you can access 24 hours a day. There might be a portal that you can log on so you can actually see what's going on with your investment on a regular basis. Now, once again, you've heard me say this before. I do not recommend that level of maintenance or watching your SPV investment. Checking it monthly or quarterly is fine. Because it is a buy and hold strategy, meaning you're going to be invested in for like 5 to 10 years, there's not going to be a lot that changes over the course of a month. Even maybe over the course of a quarter, you're not going to really start to see things happening until you get into maybe year 1, right? You might see a slow crawl up or down, but don't get encouraged or too discouraged, right? Know that this is a buy and hold. And so sometimes things have to go down in order to go up, right? And if they go up, they might go down a little bit. So just be aware, right? But you can also ask in advance while you're vetting the sponsor, how often am I going to hear from you? You can ask them that question. It is perfectly reasonable if they don't already tell you. Sometimes that information is actually going to be put into the information that they provide to you about not only about them as a sponsor, but also as part of the investment deck that they're going to show you. So now let's talk about the taxes and the paperwork. So remember, I told you you're going to receive a K-1 every year. That's a schedule that is a part of your tax documents, right? It shows your share of profit or loss, and you'll need to save it for the tax season. If you join multiple SPVs, you'll need to expect multiple K-1s. Typically what I do is whenever I get those tax documents in the mail, I actually have a place that they go. I have a file for that year that anything that comes in, I don't even open the envelope. I literally take it to this folder. I drop it in the folder so when I get ready to do the taxes, they're all in the envelopes. They haven't fallen out. They haven't separated. And I just take everything out all at the same time. When I get ready to sit down with my accountant to do the taxes, I open all the envelopes all at the same time and everything's all in one place. Maybe you have a box, maybe you have an envelope, but definitely you want to make sure you hold on to them, because what you don't want to have happen is you file your taxes and you forgot to include something from one or two more of your K1s that you received. Okay, now let's talk about red flags. Here's what I tell all of the clients that I work with. Before you wire one single dollar, vet the opportunity. And here's what to look out for. One, the sponsor can't explain the deal in plain language that you can understand. And if they are doing their best to talk plain language and you still don't understand, maybe you're not ready for this type of investment. Maybe you need to get a little more educated, get a little bit more tuition on learning about the strategy and how to navigate it before you actually put in one red penny. Two, the fees are vague or maybe even excessive. Ask, what's the carry? What's the setup fee? These are the type of fees. But once again, if they are good at what they do, all of this should be outlined in documentation that they give to you to be able to review so that you can understand whether or not it's ideal for you and that it aligns with your financial journey and your current holdings, your cash holdings. Number three, there's no deal memo or founder interview. So a deal memo is what is, sometimes you might hear called an investment memo, a deal memo, but it outlines what the deal is, what you're investing in, how much you're investing, what the anticipated return is going to be, what the tenure of the investment is going to be, who's going to be managing it, how you're going to be communicating with. All of that's going to be in the deal memo. If they don't give you one, red flag. Run, run, run. First class ticket out of there, okay? Or they don't let you interview the founder. That could be a red flag as well, right? You want to be able to know who you're investing in, right? And because it is a single purpose, unlike a fund, right? A private equity fund that has a bunch of deals, this is only one deal. So there should be something, some kind of give and take. Maybe it's an interview, maybe it's a video call, but there's some way that you get to meet the person who's managing the investment that's being invested in. Next, you're being pressured to invest fast. Big, huge red flag. For me, I don't care what the circumstances are. There are very few circumstances where I feel that I have to respond just because somebody is telling me I have to respond in a certain amount of time. I have found that a lot of times that when somebody tells you that, it's actually a false trigger. And so if somebody's saying, "Oh, if you don't write this check by tomorrow, you're going to miss the opportunity." You know what? Then I'm going to miss the opportunity because I need to get more information. And I encourage you to do that, especially as it relates to investing decisions. Next, you don't understand the exit strategy. If it doesn't make sense to you, then it may not make sense, right? A lot of times we doubt ourselves when our gut is telling us, there's something about this that doesn't feel right. Maybe I don't understand, but also maybe there's nothing to understand. So if you don't understand like how the company is going to exit and give you your money back, whether that's return of principal or the return of principal plus an additional amount of money, then maybe it's not the opportunity you think that it is. And here's my thing. If it sounds too good to be true, well, you know the rest, right? So now let's talk about how you actually get started step by step. So step one, first, you need to make sure that you're an accredited investor or check what your accredited investor status is. You can use sites like verifyinvestor.com or you can consult with your CPA. But the rules are pretty clear around that $200,000 of annual income. Now, that doesn't necessarily mean income from a job, right? It just means that you have sources of capital that total $200,000 as an individual or $300,000 as a couple, or that you have $1 million in asset, not including your primary residence. So that's a pretty easy one. But if you're not sure, you can go and total up all of your assets Usually a bank can give you what's called an investment or a financial statement. It's a spreadsheet or a form you can fill out, and it'll tell you what your net worth is, and then that will let you know whether or not you're accredited or non-accredited investor. So that was step one. Find out what your accredited investor status is. Step two, join a platform or a network. Pick one or two and get familiar with the landscape, right? Once again, we talked about this even with investing clubs. Go and find one. The first one may not be the right one. It might take you a few to find out what is going to be the right space for you. Step three, start small, but your first SPV should be with a sponsor you trust. $1,000 to $5,000 is a really good investment range that you should feel safe with. Number four, track your investments. Use something like Notion or Airtable or Excel to track timelines, updates, or expected outcomes. Step five, stay diversified. Don't put all your eggs in one basket in one deal. Aim for 5 to 10 over time. So, here's some final words. SPVs are magical. They're a tool, but for wealth builders, women with money goals, rural investors, apartment dwellers, and values-aligned capital movers, they offer something powerful, and that is access. Access to growth, access to opportunity, access to a collective instrument with people that you trust. So now that you know what an SPV is, you know what to look for, and you know how to get started, all that's left is to do it. So that wraps up today's episode of the Do Different Better Show. I hope this was helpful. If it was, send it to someone you know who's curious about investing but overwhelmed by the noise, or they're trying to stay small and not necessarily go big right at first. You don't need to know everything to get started. You just need to know who to listen to. I'm your girl, Elaine Rasmussen, and I will see you next time for another round of Wealth, Wisdom, and Money Moves. I have a special guest, Astrid Scholes from Armillaria. He's going to be joining me. I want you to keep doing different better. Let me know if you'd like a downloadable checklist. Come and hit me up on the YouTube. I've got some other snippets that I'm going to be providing, but I can't wait to see you next time on the show when I get to show you how to do different better. I'll see you next time.